If you're watching the markets in 2025 and feeling uneasy, you're not alone. Recent tariffs announced between the US and China and retaliatory measures have rattled investor confidence and pushed major indexes into correction territory, with the S&P having the worst quarter since 2022. The headlines scream uncertainty, portfolios are flashing red, and it's natural to wonder if now is the time to retreat or lean in and make a bold move. But what if this dip presents a golden opportunity? Specifically, could front-loading your 401k right now be one of the smartest financial moves you make this year? What does it mean to front-load your 401k? Front-loading means contributing a significant portion, or even the entirety or tenure of your annual 401k limit early in the year, rather than spreading it out evenly over each paycheck. For 2025, the IRS allows up to $23,000 in contributions, or $30,500 if you're 50 or older. Instead of monthly contributions, you might hit the cap by spring, locking in more shares while the market is still down. If you have money in the bank to pay your bills, there could be a brilliant time to rob Peter to pay Paul and put more in your 401k while prices are lower. Why front-loading could make sense right now. 1, you're buying while it's on sale. With markets down thanks to tariff-fueled volatility, stock prices and index funds are lower than in months, especially in technology. Front-loading lets you scoop up more shares for the same dollar, positioning you to benefit when the market eventually rebounds. Second time in the market. Beats timing the market. Getting your money in earlier gives those dollars more time to grow. Compounding works best with time on your side, and historically, markets bounce back, often when investors least expect it. This is what helps the snowball effect. 3, it takes the emotion out. It's hard not to let emotions cloud your decisions during turbulent times. Front-loading is a way to make a strategic move and let the market do its thing without constantly second-guessing yourself throughout the year. Are there any pitfalls? 1, you could miss the employer match. Some companies only match contributions per pay period. If you max out early, you might leave employer dollars on the table for the rest of the year. It's essential to read the company Summary Plan Description, SPD, to see how your plan handles matches before front-loading. 2, you might not be catching the bottom. Markets can always fall further. Front-loading doesn't guarantee you're buying at the lowest point, and there's a chance your investments dip more before they rise. If the tariff war continues, this could send markets further down this year before they rebound. 3, cash flow can get tight. Front-loading requires flexibility to take a hit to your take-home pay early in the year. It might not be worth it if that will stress your budget or force you to dip into savings. Consider a hybrid strategy. If going all in feels too aggressive, consider a partial front load. Increase your contributions for the next few months while prices are still down, then return to your regular pace. This gives you some upside potential while keeping cash flow manageable. Ted's final thought. It's easy to get spooked when the market drops, but often the best financial moves are made when things feel uncertain. If your budget allows and your plan supports it, front-loading your 401k in a down market, especially one driven by temporary shocks like tariffs, might be your best financial move in 2025. Thanks for watching.